Hello, this is Brad Harvey with Harvey Investment Management with our year-end 2023 update. This certainly was an interesting year from start to finish, and the fourth quarter was downright special. We began the year in a lot of turmoil, still coming out of COVID, and lots of turmoil in the world, and lots of wars and other things going on, but I'm going to focus on what happened in the financial markets. And like I said, the recovery in the fourth quarter was dramatic. And what I mean by dramatic is the bulk of the returns that we had for the entire year have come in the last 3 months, in particular the last 2 months. So let's go through the numbers. The Dow Jones Industrial Average for the year was up 13.7%. Now in the fourth quarter it was up 12.5%. While the S&P 500 was up 24.35%, in the fourth quarter it was up 11.26%. The NASDAQ 100, which is tech heavy, for the year was up a whopping 53.79%. And 14.3% of that came in the fourth quarter. Again, the fourth quarter was breathtaking in the stock markets. The Russell 3000, which is a broad market index, was up 23.9% for the year. And the Russell 2000, the small cap index, was up 15.1%. Interestingly enough, the small cap index was up 13.5% in the fourth quarter, and it is still 17% away from its all-time high. The other equity indexes for the US actually are at or exceeded their all-time highs in the last couple of weeks. Moving on into the foreign markets, the foreign large caps were up 14.79% year to date, and the foreign small caps, also known as emerging markets, are up 6.23%. So moving on to the bond markets, the 10-year yield actually stayed roughly the same at the end of the year as it started the year. Believe it or not, the 10-year yield at the end of 2022 was 3.879, and we closed out the year at 3.866. That's pretty flat, and we certainly saw a lot of volatility in there. While the Barclays aggregate average, remember that's mostly corporate bonds, all good quality, for the year, not including dividends, was actually up 2.33%. Long treasuries were down 0.68 and long zero treasuries were down 2.17. Keep in mind, it was certainly a volatile year for interest rates, but they did start to come down in the fourth quarter. And as a result of that, not only did we see small caps rallying, but REITs rallied as well. REITs for the year were up 7.13%, but they were up 16.79% in the fourth quarter. Definitely moving with that tailwind of interest rates going down. Moving on to the commodities markets, the commodities broad-based index, the Goldman Sachs Commodity Index, down 10.59% for the year, while gold was actually up 12.71, but oil was down 11.45. So all over the place with commodities, but that means that inflation is coming down. Remember, commodities inflation tend to move together. Also, the dollar, which added to that commodity pressure, was down 2.15% for the year. Inflation's running around 3.1% year over year, which certainly has come down quite a lot. That's why our base case for next year is saying that interest rates are going to be stable to declining. And remember, that creates tailwind for small caps, REITs, and certainly for long treasuries. So start moving some money from cash into long-dated, high-quality bonds that are fixed rate. Remember, variable rate, that's not what we want. We wanted that 3 years ago as interest rates were starting to go up. As they're starting to stabilize and come down, we want to start moving back into what we call duration risk, longer-term bonds with fixed rates. So this is Brad Harvey with our 2023 year-end update. Thank you for watching.